Many NRIs always get confused about their tax liability in India. They find it difficult to understand which income is going to attract tax liability or why any particular source of income is exempted. Only when you understand the tax implications, you can actually make better investment decisions, an informed one. Hello everyone, welcome to Keerthi's FinFo NRI community. I'm CS Keerthina. I live in Dubai and I run The Consultancy, a firm which is specialized in NRI services. I've done my CS from India, CMA strategic level from UK, and I'm also a SEBI registered overseas MFT. Every week, I bring you and explain a video on various topics related to NRI issues in this channel. If you're looking for finance, investment, and FEMA related topics, please subscribe this channel. Many NRIs always get confused about their tax liability in India. They find it difficult to understand which income is going to attract tax liability or why any particular source of income is exempted. So it's really critical to understand how, as NRIs, we are taxed. As an NRI, you don't have to pay any cost for such ignorance in the future. Secondly, only when you understand the tax implications, you can actually make better investment decisions, an informed one. This is also a first crucial step to decide which tax regime is suitable for you, old or new. So in this video, let's see how an NRI is taxed in India and is filing ITR or income tax return is compulsory for NRIs. So let's start. How NRIs are taxed. Firstly, you must understand that there are some residency rules specified in Income Tax Act. Because if an NRI becomes tax resident, then entire global income is going to be taxed. Here is a detailed video on who is NRI. Watch it if you haven't done so far because it is very important. India also follows source-based taxation. That means if you have generated any income from Indian sources, then it is also going to attract tax. So identifying where is the source is a critical point here. So let's visit the sources of income briefly for better understanding from NRI perspective. So what are the heads of income? First one, salary received in India. If any income is accrued or earned in India, then it is going to be taxable. Though it is a case-specific interpretation, for better understanding of the concept, let me explain with an example how it works. Ram, he has gone to India for any short-term assignment to provide maybe technical or professional services to the client base in India. So the service is actually rendered in India. Salary may be received in overseas account, but this will attract income tax because he is getting income earned or accrued in India. There are many such examples. It's very difficult to discuss everything in one video because you need actually professional expertise. It's actually case specific also. So this example is just to throw on what can happen in the specific case. And even if you think that I am an NRI and how can I have salary in India, there can be some particular instances or circumstances which can fall under this head. The second one is house property. This is the most common source of income other than FT for NRIs. So you may be receiving rental income in your NRO account, but if the property is situated within India, then you should be ready to pay tax. You can't say I'm an NRI, why should I pay tax? What is allowed as deduction here? Standard deduction of 30% and property taxes paid. If you have availed home loan, then the interest on the home loan, property registration charges and the stamp duty which you have paid while buying that property, as well as principal amount of the loan which is subject to the limit of Section 80C is allowed as deductions. Remember, in case of NRIs, there is TDS or tax deducted at source or the amount which is withheld before remittance is 30% flat for rental income also. Next one is income from capital gain. So I am sure that this is one of the head of the income which majority of the NRIs have. See, any capital gain on the transfer of capital asset which is located or situated in India is going to attract tax. So this includes property, investment in your shares or the securities, anything. In case if you are selling house property, then the long-term capital gain is 20%, short-term is 30%. And the buyer is responsible for depositing the tax deducted at source with the IT department. And the tenant is also responsible to produce a form 15CA, and in case remittances exceeding 5 lakh rupees, Form 15CB from the chartered accountant. I know what you're thinking right now. Is there any way where we can avoid this high rate of capital gain taxation? Yes. The relevant section to be considered here are Section 54, Section 54F, and Section 54EC. Under Section 54, you can actually reinvest in another residential property. There are further conditions attached, such as reinvestment should be made within 2 years from the sale date in case it is a fresh purchase, or 3 years in case you are going for construction. And also you can't sell before 3 years the reinvested property. The entire capital gain reinvested will be recovered. And also one more point you have to remember here is, if only a portion of long-term capital gain you are going to reinvest instead of the full amount, then only the portion which was reinvested is going to be considered. What has left out or what you have not reinvested, it's going to be taxed. So let's move on to Section 54F. Here, capital gain exemption is given if any other asset other than the house property. So the focus point is other than the house property is sold, and this reinvestment is made in another house property. So what you're selling is other than house property. Reinvestment is in only residential property. So what comes under other than house property? Of course, you guessed it right. It may be commercial complexes, stocks, mutual fund, gold, anything. Here, it is not capital gain but reinvestment of entire sale proceeds. Means what you have got after selling, entire sale proceed is to be done as reinvestment. See, you may sell number of the property in case of commercial property or another capital assets, but at the time of the sale, it is required that you shouldn't have owned more than one house property. And that means when you are selling, if you have two residential properties, this is not coming to your rescue. You should have one residential property. Don't get it confused with commercial property or any other asset. So at the time of selling this, any other assets which I have mentioned above, you can own only one single house property or residential property, and reinvestment is supposed to be made with another residential property. So it is 1 plus 1. I hope the point is very clear and there is no room for doubts here. In case if you have any doubts, please feel free to ask in the comment section. And in case if you really want to see more of these contents, then please share this and like this video so that it reaches to many NRIs. And the last critical point which you have to remember under this section is Budget 2023 had also capped the maximum limit at 10 crore. So you can't keep on claiming the exemption to endless number of properties. So the maximum limit is capped at 10 crores. I know that for you and me, maybe it is enough. Under Section 54EC, what is the exemption you can avail? See, here, where the house property is sold, within 6 months, capital gain can be invested in qualifying bonds such as NHAI or REC, etc. Then the capital gain tax can be saved. The upper limit here is just 50 lakhs rupees. And remember, this also has lock-in period of 5 years. The last one is income from other sources such as dividends, interest, etc. Please note, only NRI and FCNR deposits are specifically exempted from taxation. So these are going to be tax-free. And if you are having any interest income from NRO, this is going to be taxed. Now let's see, there is something called special provision related to investment income of NRIs. What is the special provision? If you are NRI and you have only investment income from shares, debentures of the Indian companies, deposits from the bank, or securities issued by the central government, these are all the categories which are notified, and no other asset class you have invested, means there is no rent or there are no other income sources. So you have a good as well as bad news here. If you choose this special provision, let's start with good news. Good news is, if only these investments you are holding in India, TDS is deducted at 20%, then there is no need of filing ITR or income tax return. Then what is the bad news? No benefit of indexation while selling the asset. Only the exemption under Section 54 exists for you. And furthermore, no deduction under Section 80 also exists for this if you exercise this option. So this is your bad news. Now that you understood what constitutes your income base in India, or what are the different heads of income which you have to consider, or what are Indian sourced income, now let us move on to, as NRI, should you file tax return? Yes, if you have any income earned, arising or accrued in India. So even the cases where income is deemed to be arising or accruing, you're going to be taxed. If you have income under the sources mentioned above, please take a professional opinion, because maybe many times it is not straightforward. You need actually professional opinion on that. Even the income received in India sometimes falls within taxation. though you are an NRI. So just because you don't cross basic exemption limit of 2.5 or 3 lakhs doesn't mean that you have no tax liability. At the consultancy, we are assisting NRIs around the globe in managing their tax obligations, ensuring that you stay compliant and resolve all your tax related queries. So in case if you need any professional assistance, please click the link given in the description. Our team will get in touch with you. I hope you loved this video. Please don't forget to subscribe the channel if you're looking for more such NRI contents. See you next week with another interesting topic. Till then, bye bye.